Hi, my name is Patrick Runyen. I'm a principal and wealth manager from Modera Wealth Management. We're now in part 3 of the tax effective charitable giving video series. So we're going to be discussing giving assets that we consider to be, or we like to call, appreciated securities. So just to review what that means, the easiest example to use is a marketable investment. So think about a stock, a bond, a mutual fund, etc. You've purchased it outside of a retirement account, and you've established what we call a cost basis. So you've purchased it, and over time, that investment has risen in value for one reason or another. So now you sit on what's called an unrealized capital gain. If you were to sell that investment, you would ultimately pay tax on the gain portion of what you sold. Okay, so the neat thing about charitable organizations, there's lots of neat things, but the neat thing about charities is that they don't pay tax. They're not subject to income tax along the way. So what this enables us to do is, instead of giving cash to a charity, we can give a security that's appreciated of the same value, give it to the charity, and they ultimately benefit in the same way as receiving cash. And what does that do for us? Well, it gives us the ability to not only receive a tax deduction potentially on our tax return, but also move out a unrealized gain off of our balance sheet, our personal net worth, and give it to the charity and not have to pay tax on that gain. So let's go through a quick example to further solidify this concept. So as you can see here, we have the idea of buying an investment. Let's say we bought Apple stock, and we bought 100 shares when it was trading at $50 per share. Well, what we paid, or our principal, and sometimes called cost basis for that stock, is $5,000. So at that time, we purchased $5,000 worth of Apple stock, and Apple has done tremendously well. And now we sit here today, a number of years later, and we are sitting on a $250 share of Apple, and considering 100 shares, we now have $25,000 worth of Apple. So we have an unrealized $20,000 gain. If we were to sell that, and just to make the numbers easy, if we were in the 20% long-term capital gain bracket, we would owe $4,000 of tax on that gain. So really, we didn't have 25,000, we had 21,000 after tax. Still a good outcome. But let's say you decide in a particular year that you want to give $25,000 to charity. And your immediate thought is, why don't I go grab $25,000 of cash and send it to the charity? Well, what I encourage clients to do and consider is, instead of that, think about some of the holdings in your investment portfolio and use that same $25,000, send it to the charity, and now you've avoided the capital gain on that increased position. So in this case, if we were to use this Apple stock worth $25,000, we would have avoided a $4,000 tax bill for the long-term capital gain if we were to sell it. And in addition, we may be eligible, if we're itemizing our deductions, to receive a tax deduction on our current year tax return in the year the donation was made. So in that case, you're saving almost $10,000 in this example by using an appreciated security as opposed to cash. And remember, from the charitable organization standpoint, they're indifferent about which type of security they receive. So most organizations that I've worked with over the years are able to receive appreciated securities as opposed to just cash. It's always worth checking, but even churches, synagogues, smaller charities, they typically all have the ability to receive these types of securities in lieu of cash. So I hope that's helpful. Keep that in mind as you do your charitable giving. And in the last section, we'll talk about utilizing distributions from retirement plans as another effective way to give. Thank you.